Hello everybody, welcome to another episode of My Fund Manager series with Wealthy Nivesh. Today we have with us Mr. Ashwani Kumar Agarwal, who is a Senior Fund Manager with Edelweiss Mutual Fund. Ashwani is a CFA charter holder, MBA in Finance, and he has got 19 years experience in investment management industry. Ashwani has previously worked with JM Financial and Baroda Pioneer Mutual Fund. So welcome to My Fund Manager series.
Thanks,
Ashwani.
Ankur. Thanks for the introduction.
So Ashwani, let's start with a very basic question. As you manage a flexi-cap fund for Edelweiss Mutual Fund, how do you define a flexi-cap fund as per SEBI guidelines?
So flexi-cap is a new category which was launched roughly 4 years back, maybe 4 to 5 years back. So in flexi-cap, a fund manager can invest in all three classes of stocks, or rather 4 classes of stocks: large cap, mid cap, small cap, or something like a micro cap, in any proportion typically he wants. And there is no binding that I need to hold 30% large cap or 50% large cap. This ratio can be anything which a fund manager can have. The benchmark for this fund is NSE 500, and there currently the large cap percentage is roughly 72%, and the rest 28% is small cap and mid cap. And in that 28%, roughly 17 to 18% is mid cap and 9 to 10% is small cap.
Great. So Ashwani, follow-up question: what is small cap, large cap, and mid cap stock as per SEBI definition?
As per SEBI definitions, this came in just a few years back. Earlier, there was no defined large cap, small cap. People had their own definitions, all the mutual funds. So now the top 100 stocks are large cap stocks.
As per market cap?
As per market cap. And as from 101th market cap to 250th market cap company, that qualifies as mid cap stocks. And everything from 251st stock in terms of market cap qualifies as a small cap stock.
Ashwani, what is the difference between flexi cap and multi cap fund?
So flexi cap and multi cap. Flexi cap is a new category, as I said, which was started 4 years back. In flexi cap, a fund manager can invest in large cap, mid cap, small cap in any percentage they want, or any. But whereas in multi cap, SEBI has mandated that at least 25% needs to be invested in large cap, 25% in mid cap, and 25% in small cap. So the product is totally different than flexi cap. In flexi cap, I may have 70, 75%, 80 or 90%, whatever number it can be in large cap fund. But whereas in and I may have just 15, 20 or 10% in mid and small put together. But in a multi cap, I need to have 25% in each of the segments. So a multi cap would be a totally diversified portfolio. The benchmark of a multi-cap is also different. Then multi-cap has a separate benchmark, whereas the benchmark for flexi-cap is typically NSE 500.
Great. And Ashwani, another follow-up question. So as you mentioned, the current allocation is 72% in large cap. As for your fund?
As per NSE 500, that is the benchmark allocation.
Great. So, but if I look at flexi-cap as a category also, typically large cap forms 70% allocation in flexi-cap category. So is that a strategic call, or that's a tactical call, or is there any specific reason to it?
No, there are various fund managers, and they have got their own strategies if you look at. So since the benchmark is NSE 500, where the large cap allocation is roughly 70 to 72%, so people try to replicate the benchmark and have 70 to 72% in the large caps. But there are various fund managers who deviate from the benchmark, and they go as down to as low as 60% in large cap category, and they have got mid cap and small cap, which is more than 35% or 40%. And it also depends upon the market timing. If I think that I can make more money on a small cap or a mid cap, then I will have a higher allocation there. And if you see in the last 3 years, small caps and mid caps have made more money, or rather given more returns as compared to large caps. So people have shifted their preference to small caps and mid caps. Now, in the last few months, the valuations in large cap seem to be better. So now people have shifted more towards large cap. So it is all moving. But yeah, some fund managers, like they tend to be true to the value or true to the benchmark. So they like to be near about the benchmark, maybe plus 2% or minus 2%, because when you define NSE 500 as a benchmark, you are exposed to certain set of risks, certain set of factors. And that set of factors, your large cap exposure is 70%, for example, then I'm exposed to certain risk there. And if in the portfolio, if I'm having a 55 or a 60% large cap and a more of mid and small cap, then my risk exposure increases. So it is all dependent on the fund manager, the fund house, what call they want to take, and whether they want to be factor based in terms of investing, that they will stick to 72% large cap in line with the benchmark, or they are ready to increase the exposure in small cap and mid cap.
So it's more of a fund manager's call.
Yeah, exactly.
Great. So now moving from mutual funds to market. So if you look at broader market like NSE 500, market has gone up by 70% in 18 months. Then it recently corrected by 10-12%. So how do you look market in coming days, more so from the perspective of earning growth?
So if you look at the earnings growth, we had fantastic last 12 quarters where earnings growth was on the high teens. Now for the first quarter and the second quarter results of FY25, we have seen some slowdown in consumption. If you look at the consumption growth was on the slower side, it was lower than expectations. We had elections in the first quarter, so the government spending was on the lower side. Even in the second quarter, the government spending was on the lower side. And the credit growth has shrunk from a 16% clip to roughly 12% clip for the month of October. So that is putting some pressure on the consumption side and on the earnings side. And hopefully the government starts spending again from the month of November. Then we should see some uptick in the consumptions. But for the time being, I would say that the best of the earnings season may be behind us. From here onwards, you would see typically a compounding story from here in terms of earnings.
And another very unique development recently was that typically they say that when markets correct, small and mid cap corrects more than large cap. But recent correction has been more or less secular across all three. All three have corrected by 11 to 13%. So how do you look at it? Is there any specific reasons to it?
The correction in the large caps was just by a few companies because the slowdown in the consumption in second quarter was much more than anticipated. So as a result, few of the consumption names had to take a big knock. They were large cap companies. That's why we see the large caps correcting. And many of the companies which you see over mid caps maybe 2-3 years back, they have become large caps and they were trading at very high valuations. So there the order inflow was on the lower side, or the earnings growth which was expected was lesser. So they came down because the valuations were frothy in some, and in some cases the earnings were on the lower side. Hence they corrected. But when we say correction, whether it's a large cap company, small cap company, or a mid cap company, if your earnings trajectory is fine, there is no problem as such, and valuations are not out of the whack, then it wouldn't correct. So something which is trading at 50-60 times P for a 1 year forward multiple, and the earnings are not in line, or if it's just a hope story, then the correction would be there.
Correct. So you mentioned valuation. So if you can take our audience through valuation of a small, mid and large cap and how they compare with long-term valuation of each index.
So if you look at the valuations of large cap, mid cap, small cap to the historic averages, now we can divide the history in two parts, the last 4 years and years before that. So in last 4 years, they are slightly above than the average valuations, but if I take a 15-year view, then they are significantly above the average currently. The thing is, the financialization of the country has just started 4 years, 5 years back. We had talked about that all our assets are either in gold or real estate for a long period of time, and we wanted financialization. So this is the first leg of financialization which has started, where we see a number of demat accounts increasing from 4 crores to 14 crores. Our total equity AUM in India is touching about 30 lakh crores. The equity AUM, the overall mutual fund AUM is roughly 68 lakh crores. So we have just started the financialization of the country, and I think because of the lack of earnings, the valuation may correct a little, but the India growth story remains intact for the next maybe 2 decades.
If you can just dwell upon what are the benefits of ELSS as compared to other tax saving schemes, which make it more favorable for me to invest.
First of all, in ELSS you get a total equity exposure which you don't get in any other instruments, which is gives you a tax benefit as well. And in ELSS, if you see, I'm not just talking about my fund, but overall across the industry, we have the industry exposure to large cap is anything between 50% to 70-75%. So you can take an exposure in both mid cap, small cap, large cap, and play the India story for the next 3 years. And the most important thing is there is a lock-in for 3 years for
Only
the fund.
3 years only.
So a fund manager typically can take a good aggressive bet in this category and can beat the benchmark and generate slightly higher returns than other instruments on a sustained basis.
Got it. Now another question on taxation only. So we know that mutual fund are a pass-through structure.
Yes.
So what it means is that whatever buy and sell you do through your mutual fund portfolio, you don't have to pay tax on it.
Right.
And I, as an investor, have to pay tax only when I redeem my mutual fund. So how does it help me in optimizing my tax outgo?
So look at something like this. What I will say, I am if a mutual fund doesn't have to pay tax on any of its buying or trading, selling activities, whereas an individual investor, if you redeem or you sell any of your investments within 1 year, you have to pay 20% tax, and in long term, you have to pay 12.5% tax. So as a mutual fund, typically where the churn ratio is in the range of anything between 30 to 60%, you don't have to pay tax on the 30 to 60% which you redeem that day itself. You just pay taxes when you redeem your mutual fund, which may be after 1 year or 2 years. So your taxation straight away comes down from 20% to 12.5%.
Great. Another question, so there is this talk of heavy liquidity in the market. And I think a very radical and very extreme example is the recent SME IPO of a showroom, of an auto showroom having only 2 showrooms, having a top line of 12 crore, and he brought his SME IPO and it was subscribed to 420 times. So should we count such kind of scenarios at one-off kind of scenario, or we are flush with liquidity?
I think this is a one-off scenario, and definitely liquidity is there, but
certainly not in this ratio.
But not certainly not in this ratio. Maybe because the size of the SME IPO was small, that's why this number looked to be 420. But definitely liquidity has increased manifold in last 5 years with the advent of zero brokers, fintechs. It's very easy for anybody to trade. Earlier, a person had to go to a broker or call a broker and then apply for an IPO. Right now, everybody is carrying, most of the people are carrying smartphones, and it's very easy to download any of the apps. And with just the help of few clicks, you can apply in an IPO. And with social media and messengers, people are getting trading calls on a daily basis. Daily basis is too much. It may be on a minute by minute basis. So that's why we have the frenzy in the equity markets currently.
So I'll cite some numbers over here. So before Corona, the number of mutual fund investors in India was 15 million. After Corona, it became 25 million. Now it's around 50 million. Still, it is less than half of crypto investors in India, which is like 120 million. So do you think, like we talk, our economy is going through formalization? Do you think that kind of formalization will also come in savings in India, that people will move more their assets into financial assets than tangible assets?
This is happening because if you see today, savings accounts give you 3 to 4% interest rate. Fixed deposits give you anything between 5 to 7%. The real estate cycle was in a bad shape from 2030 till 2021, and from 2021 it has picked up. But in real estate, you have to put in a large chunk of money to make money. But whereas in equities, the cycles are smaller, and the ticket size is much small. You can start a SIP with as low as 500 to 1,000 rupees, right? And there is you can withdraw the money whenever you want. There is the entry barriers or exit barriers are very less in a mutual fund as compared to other asset classes. For example, if you want to withdraw a fixed deposit, you have to pay an 1% or 0.5% charge if you withdraw it before some time, and the returns are much lower as compared to an equity scheme of a mutual fund. So I think financialization is here to stay. If you look at our demography, we have got 70% of people are less than the age of 45, I would say. So as these people age, they start earning more money. They will have extra money which they will deploy in assets or investments which earn more than inflation. And I think equity is one of the best investments which can be inflation hedged. So
Ashwini, if I'm a first time investor, how should I start my investment journey in mutual funds?
So the best way to start your journey in a mutual fund is to start with a SIP, and it all depends upon your risk profile, that at what age you are starting. So if you are in early 20s, it's best to start with, because since you have a 40-year horizon, and I'm assuming that you don't have very pressing needs of withdrawing money, then you should have a higher allocation to small cap, mid cap, and then a large cap in that category. And that is the way to start SIP, because nobody can really time the market. I cannot say that the market is best suited right now. Any day you start is a good time, and SIP is the best way to start.
So let's say I start with a minimal amount in SIP, and then I keep on building it as my confidence grows in the asset. Which are the categories of mutual fund where I should start with? So I think ELSS is good because I can save money on tax.
Yeah, because typically when you start with a salary where your PF is not contributing fully to your ATC benefits. So you want some investment where you can save money. So ELSS is a very good way to start your investing, where the money grows and you also get the tax benefit. And along with ELSS, there are other schemes definitely to put in money. It all depends upon your risk profile, your financial ability, your whatever requirements you have. So if you have got a good 40 year horizon, or at least a 15-year horizon, for example, I'm assuming a person who is at the age of 20 starts investing, he may be having at least 7-8 years before he gets married. So that's the first time when he will require funds. He may require funds. So even a 7-8 year is a good time to start with a small cap, mid cap investment and large cap investment with a certain percentage, heavy percentage bias towards small and mid cap to invest in.
So as they say, start slow, start small, but then you keep on building on the
keep on building it up. Exactly.
Great. Thank you, Ashwini. Thanks for the
My pleasure,
session. It was a pleasure talking to you.
Same here.
Thank you.
Thanks.